Risk and volatility sound like interchangeable words, but they really are not. There's a marked difference between risk and volatility. Risk is the probability that an investment will go to zero or have a permanent loss. When I think of risk, I think of Enron. Stock shares of this energy company reached their highest point on August 23, 2000 at $90.75 a share. By the end of November 2001, the stock price had fallen to below $1 a share. December 2nd, they claimed bankruptcy. Millions in wealth was lost permanently. Volatility is different. Volatility is how much the price of an investment can change or bounce around. Each investment comes with an amount of volatility. There are investments with very low volatility, like government bonds. However, those bonds have a low rate of return. As the opportunity for return increases, so does the volatility. Stocks often offer more return than bonds over time. It should come as no surprise that stocks can have more volatility. We see their prices change in a more dramatic way than bonds. Some of the highest risk investments are individual stocks and bonds, like that Enron example I gave. If something bad happens to that company, your investment in that stock or bond could be at risk. Thankfully, risk can be reduced, and we do this through diversification. When we hold a portfolio of stocks and bonds, it could reduce risk. A great example of that is a mutual fund, index fund, or an exchange-traded fund. These funds have lots of holdings or individual stocks and bonds. Having lots of holdings can help minimize risk by limiting exposure or concentration in any one stock or bond. You will still experience volatility or price changes, but you may reduce the overall risk associated with permanent loss.